information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
And welcome. Hello to a special edition of Your Money, Your Call, and tonight we're taking you behind the scenes to the bond market and also to industry super funds. Because you know that when it comes to investing, it's not just about the equities, there's more to equities, it's also about bonds. So my name is Mark Todd, I'm Director of Fixed Income Sales at FIIG, and we have a great show for you tonight. Now, if you'd like to be part of that show, please email us on yourmoney@skynews.com.au, or you can call us through on 1300 30 34 35. If you have any questions on fixed income, industry funds, term deposits, investing, now's the time to ask it. Joining me tonight, we have Christopher Joy from Yellow Brick Road Funds Management. He's also a columnist with the AFR, and we have the CIO of Uni Super, John Pearce, and they're here to answer your questions. Welcome, gentlemen. How are you? I suppose the thing to think about at the moment is today ANZ comes out, cash rates, they expect 2% by the end of the year. Looking at the year in review, I guess the idea that cash rates going to 2%, the cash rates have driven so much of the conversation. How do I get a return? How do I get a return that I can live on? What investment assets do I look to buy? You know, how do I allocate my money? I suppose, you know, the easy question in December is to ask, how was your year? How was 2012 for you?
Mark, it was pretty good for us. We launched an active cash fund, YBR Smarter Money, which has performed very well, so it more or less topped its Morningstar universe. Right. But as you mentioned, we've seen the cash rate fall from 4.25% to 3%, so we've had 1.25 percentage points worth of cash rate cuts in an environment where the economy has grown around trend and the unemployment rate has been about 5.2%. So these are, I think, unusual circumstances because the RBA has put in a lot of preemptive insurance, but generally I think for most investors, equities, bonds, cash not so much, and housing, folks have done pretty well.
Yeah, right. What about the industry super world, John? How'd you go?
Same. If you wish every year was as good as 2012. Yep. Our balanced option is going to record, barring a catastrophe in the next 2 weeks of this year, about a 13% return, and so that's a typical 70% growth, 30% defensive split. That puts us at the higher end of the league table, which is also good. A couple of things have gone well for us. We got on early in the this equity yield sort of play, yep. So we started allocating to that about 12 to 18 months ago.
Which is it's the Telstra, it's the banks, it's the things that
the Woolies,
we in the FIIG world would say it's the bond-like performance of equity, but rather than denigrating the bond-like performance, it's all those guys have been very popular, haven't they? You know, in the middle of the year, everyone said equities are going really badly, it's terrible, but within that equity cycle, there have been things like Telstra just continues to move forward, and people say that the equities are performing weakly, but then you look at Telstra and you look at the banks and you say, no, it's about trying to get a yield. It's trying to get something that compensates what the term deposits weren't giving you, isn't that right?
Yeah. Look, I guess the big question is where do we go from here? Because, you know, we've got a lot of the commentators saying that this they're expensive defensive now, the term they use, and you know, this trade is looking like it's near the end. We don't agree. If you look at on a relative basis to what the fixed interest market's offering, we think there is still a run here. You know, things get expensive when they get ridiculously overvalued while they're getting more fully priced. We think there's still a run there. And if you look at the absolute yields, you know, the Telstras, the banks, we're still talking gross yields of between 8 and 10%. Right. You know, for a pension member or a super member with a tax rate of between 0 and 15%, where franking is cash in the hand, they're pretty attractive yields.
What about you, Chris? I mean, when you look for the 2013 year, and John spoke about it, the next 2 weeks, hopefully there's no complete catastrophe, but I look in the United States and I say they have potential for complete catastrophes. They can always overshoot when they surprise us, because we assume the politicians will get it right. But 2013, what do you like the look of? How do you see the year? And when we talk about the black swan, the things that you can't predict, the Rumsfeld effect, What do you imagine 2013 will look like?
Well, just before we get on to 2013, let me say that as soon as the RBA started cutting rates in November and December last year, we thought equities had a good chance of outperforming. And we've actually had 17% capital growth plus dividend performance from equities in 2013. So I think that's been quite predictable, and likewise the housing market has stabilised. In 2013, what I think gives us most pause is the risk of higher secular inflation. So we've seen global central banks around the world floor interest rates. We're seeing central banks print money in order to fund government deficits and the issuance of government debt. And there is a significant risk, we think, over the next 1, 2 and 3 years that inflation expectations increase. What that means is we're likely to get higher long-term market interest rates, and that will drive potential capital losses to the holders of fixed rate debt. The holders of floating rate debt we think will do well in the medium term as interest rates normalise and come off these multi-decade lows. But I think there is a real risk of a bit of a bloodbath like 94-95 in the fixed rate debt market.
But when you say that, and I understand in terms of the movement in the fixed rate piece, we're thinking maybe the government bonds get sold off and the like. Anecdotally, that's not how I feel, in that I see any of these things being sold off a Telstra or a Westpac bond, and you start to get 6% on those sorts of bonds. I just think you couldn't stop the amount of money that would come in. So relative value, that's all fine and good, and I understand that. But in terms of your traditional investor who is unsure of that volatility, whatever created that sell-off, they're nervous enough to say, I better buy something I understand, which is a Telstra or a CBA or a whatever sort of, a Wesfarmers bond. Wouldn't you agree that they'll look to buy into that fixed return if they can get 6%?
Yeah, so I think you're touching on two different issues here. One is the strategic asset allocation problem for folks as the population ages and they want to reduce their exposure to volatile asset classes that in turn expose them to the risk of capital loss, and they want that certainty and security of income. So I think that's going to drive demand for cash and fixed income. The alternative is the tactical asset allocation question, and that is, where are we currently in the interest rate cycle? And if interest rates, which they are, borrowing rates today are at 40-year lows, savings rates, some savings rates are below all-time lows. The cash rate is at its all-time low, and there's obviously a risk that rate gets normalised in the medium term, and that will create real problems for the current owners of fixed rate debt. But that's more a market timing question.
Okay, I do want to talk to you about that again, because I think that cycle, John and I, we can all talk about what that cycle now means, but we've got a caller in. We've got Chaz from Sydney. Chaz, can you give us your question, please?
Oh, hi, Chris. This is Jazz from Sydney. I'm actually an investor in YBR Smarter Money. So firstly, I've been very happy with the return, so thank you for that. Good. I do have a question for you. Would you be able to explain the difference between fixed rate and variable rate bonds?
Yeah, that's a really good question, and obviously it's what we've been talking about just a moment ago. So with a floating rate bond, and this isn't widely appreciated in the retail market, but with a floating rate bond, basically your interest rate moves up and down with the RBA cash rate. So as the RBA lifts interest rates, and if inflation does increase in the future, you'll get better returns, and likewise if we went into a recession, you'll get lower interest rates, but you don't have any capital risk. The value of your bond really is unaffected by changes in interest rates. A fixed rate bond results in you locking in your interest rate today, and if outside interest rates were to increase, the value of that bond would fall. Alternatively, for the last few years, interest rates have been falling, so folks who locked in their rates years ago have actually got embedded capital growth, and the risk is, of course, that cycle turns. As an example, over the last year, 10-year Aussie government bonds have given a total return of 8%, but the underlying coupon, or the interest rate paid by those bonds, has only been about 3 to 4%. So a lot of that has been capital growth.
Great summation. Other than a great summation, John, can I just ask you, to Chris's point, low cash rates, 2013, your anticipation, do you agree? What's that look like for you? Is it low cash rates for the next 3 years? And so going back to a normalised cycle in 2013?
Chris alluded to the risk of inflation. That is ever present, but it's not our central thesis. And you look at something like Japan, where for 2 decades we've had low interest rates, quantitative easings, and it's been a deflationary spiral. We think the risks of deflation around the world, not in Australia, are as high as inflation. Our central thesis is that inflation will be within the Reserve Bank's range. Rates are going to be low, and they're going to be low for a long time, is our central thesis.
you know, I would be remiss if I didn't say, why aren't we all buying inflation-linked bonds? You know, we know it's there. We don't have to put the house on it, but surely that's going to be the great growth. That companies come out and look to issue something that's linked to inflation. So we see a lot of business in Sydney Airport. They've got all these annuities linked to inflation. They seem to be very popular with a lot of people. Senior debt, why wouldn't you imagine that will continue to grow as an asset class in its own right? You know, the government's inflation-linked bonds are at, I don't know, half a basis point. So would you imagine, I suppose to you, Chris, first, and then to you, John, what do you think about the inflation-linked bonds?
I think inflation-linked bonds have a lot of merit because, as I said, our view, a little bit differently to John's, is that in the long run, with very, very low interest rates and with every central bank in the world printing money, the balance of risks lie to higher inflation. We've already seen in Australia in the last, in the 6 months to September this year, we had core inflation running at 2.8%, which is above the RBA's target. Yeah. And this is where inflation-linked bonds can play a very, very valuable role. The one thing I'd say is inflation-linked bonds are a little complicated for the mainstream punter, and I think a de facto alternative to inflation-linked bonds is short-term cash, because the Reserve Bank of Australia targets inflation with its cash rate, and what we find is there's a really, really strong correlation between the RBA's target cash rate and the inflation rate. So that gives you that real return that an inflation-linked bond would give you, albeit without the precision that it offers.
So it's all about education, and John, you're UniSuper, so you know you're the educating fund. Tell me a bit about UniSuper itself. You know, I see all the time ads for industry super funds and the like, but it's just an ad. It's very hard to come to grips with what it actually means. So can you give me a sense of UniSuper and what you're about?
Well, you won't get ads from us. No. We're not a public offer fund, so the viewers will be pleased to know I've got nothing to sell them. We're a fund that's dedicated exclusively to higher education industry, about a $30 billion fund, and we have your typical split of asset classes. We've got a cash option, we've got a high growth option, but the bulk of our money sits in your typical balance type options, where most of the money's in a growth type assets and 30% defensive.
Okay. Now, just reminding people, if you do want to call in, please give us a call on 1300 30 34 35, or you can email us directly, yourmoney@skynews.com.au. We've spoken about 2013 and how the year is going to play out, but tell me, what do you like the most on the investment horizon? What's the best call? What's your number one call? If you had to put your money on one thing, what would you put it on? You've only got one thing. That's it.
Over what time horizon?
2013. You've got one thing to put your money on.
Frankly, I think equities and risk asset classes will do well in 2013 because the RBA is deliberately trying to stimulate investment, consumption, spending, and as I mentioned before, when you look at real savings rates, so if you take bank deposit rates and you strip out inflation, I published a column in the AFR on the weekend that showed that savings rates are actually generating real returns after inflation for only the third time in 23 years. So that's encouraging folks to look for higher yield, either in riskier debt, so sub-investment grade debt, or in shares. So I think 2013 will all be about risk asset classes, equities and housing.
John, you got one. We can't nominate a share because that would be inappropriate, but
right. Well,
what are you going to put your money on?
Because of currency risk, I'm not going to invest in the US technology sector. I've only had one thing. If we didn't have currency risk, I think the US technology sector would be the place to be. But because of that, I'm happy to stay in high-yielding Australian equities.
Just before we go to a break, what do we think about the States? Is it we can put our money on it generally? We think that they will recover. They're that sort of entrepreneurial spirit. It's all about the free gas that they're now generating through the fracking. Or do we think they're political idiots and they can't organise a fiscal cliff? I mean, to you first, John, what do you think about this?
Well, look, you're right off the United States at your own peril. I mean, this is a country that has a long history of reinventing itself. If you look at their approach to the GFC, it's been textbook crisis management. They took their medicine, they took a lot of it, and they took it quickly. And you compare that to the US, European situation, where you've got the Walking Dead there with the banks. So the US has got some short-term headwinds politically. There's gridlock there, but medium term, it's they've re-engineered the corporates are in great health. They've re-engineered their balance sheets, and this shale oil revolution, it's big. This is low energy prices. Is the stuff of industrial renaissance, and that's what we could see in the US.
You agree?
Yeah, I do. I think one of the key things that distinguishes the US from, say, Japan, and you mentioned Japan earlier, is that it still has a strong immigrant culture and strong population growth, whereas Japan's population is forecast to shrink literally by 1/4 over the next 40 years. The US is benefiting from that growing underlying organic demand, which helps growth. I also think in the US they've more or less dropped their inflation target, the Fed, and they will, I think, pretty maniacally pursue that reduction in their jobless rate and growth, which is going to be good for the global economy because it is still the world's largest economy. We know that China's experienced a very modest, soft landing, and net, I think that's going to be positive for Australian business.
It's sort of the undeclared currency war, isn't it? The US has actually led the war without declaring the war. They said that we will keep rates here, we are going to push this currency down, and we're going to go back to, and we will create a manufacturing industry. The idea of such a mature economy having a new manufacturing industry is hard to imagine. We still produce cars that people don't want to buy.
Yeah, it's an interesting point. I think that the commodity currencies and the new reserve currencies, and if you look at Switzerland, the Nordic region, and Australia, we have these high currencies and elevated terms of trade, but we're benefiting also from very, very low interest rates. So I think the RBA is trying to manage that trade-off between the cost of a high currency and the stimulus afforded by record low rates.
Terrific. Look, we must go to a break. Just to remind you, if you do want to call in, it's 1300 30 34 35. Any questions you might have on fixed income, bonds, industry super funds, or just investing, please give us a call. And welcome back to Your Money, Your Call. My name is Mark Todd from FIIG, and tonight I'm joined by Christopher Joy from Yellow Brick Road Funds Management, and we have John Pearce, the CIO from UniSuper, and they're here to answer your questions tonight. And I think we might have a few questions coming through. But remember, if you do need to call us, 1300 30 34 35, or email us at yourmoney@skynews.com.au. So before we get to these questions, let's just talk about the investor sentiment. At the moment, it's clear, it's the GFC, it's a consequence of that. Investor sentiment has changed. In days gone by, they would have just put their money with their fund manager or their friend or their accountant. Now, they ask a lot more questions, and the driving question seems to be, what fees are you looking to earn? How much money will you make? You might say to them, I've got this really good trade, this is a good deal. I hear that. I just want to know how much you're earning. How do you respond to this change in investor sentiment? We'll start with you, Chris.
Yeah, I think it's very interesting. We've actually seen the savings rate bump up to about 10%. And the RBA makes the point that this is actually not unusual. The savings rate's actually returning back to the levels that prevailed during the mid-1980s. So the real question for us is this a fundamental change in consumer behaviour? Have they got some permanent brain damage that's resulting in a big increase in conservatism, which means they want much more security and certainty of income? Or will we see consumers revert back to type? And will we see consumers experience bouts of overconfidence and markets start to overshoot again with strong asset price inflation in response to the stimulus the RBA is offering them?
Now we have Tom from Turramurra. Tom wants to talk to us about the fiscal cliff. Are you there, Tom?
Yeah, I am. Hi, Mark. How are you?
Good, Tom.
Yeah, I was wondering if you could briefly explain exactly what the fiscal cliff is, and secondly, if America falls over the fiscal cliff, what's the likely fallout for us here in Australia? If you're an investor, is there something defensive that you could be doing in anticipation?
I suppose the fiscal cliff is a sliding cliff, isn't it? It's a fiscal valley. It just doesn't sound as good if you say fiscal valley. But Tom, what's happened is that the Democrats and the Republicans have got together and they've created a legislative change. The Republicans want, and correct me if anyone thinks I'm wrong on this one, but the Republicans want to stop all entitlements. And entitlements are things that you and I would take for granted, like a Medicare and Medicaid. That's what they have. It's in terms of all the people who are on some sort of benefit. The Democrats want to improve the fiscal balance sheet, and they want to tax more people. They want to go back to what they call the pre-Bush cuts, and they now call it the Buffett tax. They're prepared to pay more tax. That's the legislative piece. Is that how you understand it?
Yeah, that's right.
Now, the fiscal cliff defines we're about to hit that. We've enacted a legislation that they will now follow in January the 1st. What happens if we hit this fiscal cliff and they actually follow the enacting? John?
Well, let's first add that the way it's structured, it's so draconian to basically force these guys to a compromise. All right, so the market is is reasonably sanguine about this cliff because they feel that sanity is going to prevail, and it will indeed be. There'll be a compromise. Now, they won't have the so-called grand bargain, which is going to rectify their fiscal problems, but there'll be enough to kick the can down the road and get us through this hump, and hopefully the economy picks up, tax revenues pick up, etc. So we're reasonably sanguine as well. We think the market's got it right, but geez, the longer it takes, the closer we get to 31 December, the more nervous we get.
And they're running out of time. I mean, you and I spoke about this off camera. Yeah. The change in the environment with these terrible tragedies that have taken place, to get a political consolidation around tax when it seems to be so, not of the first order when you're dealing with such tragedies. So what happens if they don't do it?
Well, I think we've seen these rolling tail crises for the last few years that markets haven't been prepared for one way or another, and that have had a really serious impact. So there are definitely, I think, significant risks associated with the resolution of the fiscal cliff. In a worst case scenario, we'd likely see a significant fall in the value of shares, and we'd see credit spreads widen. And as John said, markets seem, for one reason or another, to be extremely confident that this risk isn't going to materialise, which obviously only ups the ante in the event that it does come to pass.
Sure, but to Tom's question about what happens to Turramurra, what happens to people who invest in Australia to the fiscal cliff? You say shares get sold off. Shares get sold off in the United States. We get sold off here in Australia. We follow it.
Yes, it'd be hard to see, a big fall in the US share market not matched by an equally large fall in Australia.
And when we say credit spreads get sold off, it help the viewers understand what you actually mean by that.
So what that means is a credit spread really tries to measure the probability of the issuer of the bond defaulting on that obligation. So if credit spreads widen, the value of those bonds fall. So what we'd see, and what we saw in fact late last year with the Euro sovereign crisis. Now, none of these worst case scenarios came to bear, but people were very worried about the European Union disintegrating, and we saw a huge increase in credit spreads. We saw the capital value of bonds fall that were exposed to those credit risks. We also saw, ironically, overall bond yields fall, so fixed rate bonds increase in value, to our point earlier about the distinction between the two, and share markets come off.
So essentially what we're looking at is the cost of lending money. If I need to lend money to you and I want 5% return, but your credit spread gets worse, I now say you better pay 10%.
Yeah, that's right. Although it's important to understand, for example, in January this year, CBA issued a AAA rated bond that cost it 1.75% over its benchmark rate. Because of the doom and gloom that was pervading at the time, the underlying benchmark rate was very, very low. So people were pricing in low, long-term interest rates on the basis that they felt there was a chance of global recession. On the other hand, the cost of CBA raising money was very, very high because people were attaching a significant risk to CBA defaulting on its obligations, which seems crazy, but
crazy. Okay, let's answer some emails. Tonight we've got one from Bill. He asks, what sort of return can I expect from a bond portfolio? And I'm not going to ask you that, John. I'm going to ask you that, Chris.
Well, it's an interesting question. It depends on what type of portfolio you have. For example, if you had a cash portfolio or a portfolio comprised of short-term floating rate bonds, we look at the last 20 years of data and we say to ourselves, what would you have got if you received 1% above the RBA cash rate over that period if you took out inflation? So after inflation, that portfolio would have given you about 4% per annum. What's interesting, so that's a very attractive return, again, after your cost of living. What's very interesting, if we go back over the last 20, 30 years and we look at long-term bonds, a very different type of security. So these have got fixed interest rates. Off the top of my head, they've since 1982, they've delivered a total return of about 11% per annum. So bonds...
11% per annum on the bonds?
Yeah, so this is...
very dull bonds?
This is Aussie government bonds. Total returns, since 1982 has been about 11% per annum. And I actually wrote a column for the AFR a few months ago about this, because normally you'd expect equities to give you a much higher premium over bonds. But in Australia, over the last 30 years, that hasn't been the case.
John, we'll be talking about this next after the break. We have to go to a break. We have a short break. But please give us a call on 1300 30 34 35 for any questions you might have on markets. We'll talk to you after the break. And welcome back to Your Money, Your Call. I'm Mark Todd from FIIG. And my guests tonight are Christopher Joy from Yellow Brick Road Funds Management, and we've got John Pearce who's at UniSuper. He is the CIO of UniSuper. And we've got a question coming through from Melbourne. The question is from Josh. Hello, Josh. How are you?
Very well.
You've got a question on hybrids.
Yeah, hybrids or bonds. I'm just wondering if you guys know of any ones, in the pipeline that'll be coming to market in the coming months.
Hybrids that are coming onto the pipeline in the pipeline in the coming months. Anything that you're aware of that you can actually speak to?
They usually don't telegraph it too far in advance. These deals are, behind closed doors. The investment banks talk about them. We usually don't get spoken to too early because they don't want to put us inside. So that pipeline. I will say, however, that with rates where they are, a lot of very solid companies are looking to refinance their debt at lower rates and also term out their debt. So they might have debt maturing in the next 1 or 2 years, taking the opportunity to retire that debt and actually increase the duration of their borrowing, which is very sensible. So we do see a lot more issuing in the near term.
I mean, clearly they're not, to your point, they're not going to tell you in advance this is what we're going to do. But in terms of the hybrid market, how do you imagine it's going to play out in 2013, Chris? Do you imagine there'll be, like John's saying, a lot of people looking to finance via the hybrid market? And what's your intuition tell you about that?
Well, I've argued for the last couple of years that many of these hybrids are bad investments because you're getting debt-style returns with equity risks. Now, the companies love issuing them because they're relatively low cost and they get to convert you often into ordinary shares when, frankly, the shit hits the fan. So you get converted into ordinary shares if, for example, they lose or get downgraded from a credit rating perspective, if their profits fall, if the regulator forces them to do so, and so forth. There have been a rush to hybrids or a rush of hybrids to the market over the last year. ASIC's starting to push back heavily on the disclosures associated with these products. But let me just say to the first part of the question, we have seen in the last probably 2 or 3 weeks, as you would have seen at FIIG, a little mini wave of issuers. So AMP raised $150 million through a bond, which wasn't a hybrid, which paid over 6%. NAB raised, I think, $950 million through another bond that paid just under 6%. And ANZ also raised $750 million through a bond paying nearly 6%, which YBR Smarter Money invested in.
Right, and I think that was to take advantage of the end of year opportunity, wasn't it? Without having anything hit the fan, would you be of the same view in terms of hybrids? It's something you need to be very careful about.
Yeah, and in terms of UniSuper's positions, we've avoided the hybrids. We've avoided the banks mainly because we think their equity is a much better deal than their hybrid. And we've avoided some of the other corporate hybrids because they're really structurally flawed. One thing, and it's a technical term, but I'll just mention the dividend stopper. They don't have what we call a dividend stopper. And put very simply, under certain circumstances, these corporates can continue to pay dividends while withholding the interest paid on the hybrid. And that's incredible. You've actually got a situation where a debt security is effectively being subordinated to an equity, which really it doesn't make any sense at all.
I mean, it's interesting that lawyers can actually write the paper. I mean, I think when you see it and you look at it, you think this can't be real. This is just, it's so offensive that there's no way anyone will put any money into that. And then bang, out it goes.
Well, it's in the small print. That's why.
Why aren't people aware of this? And I think really obvious. It's a real problem with that asset class, that they can write papers and then point to the paper and say, look, I've written it, you just didn't read it. It's your fault. That doesn't feel right.
And can I just say that a lot of these hybrids are being marketed as alternatives to cash, where, to John's point in my earlier comments, these really have embedded in them very significant risks of capital loss. And frankly, in many situations, as John's fund is doing, you'd be better off buying the high dividend yielding underlying equity rather than these sort of Frankensteinian combinations of debt and equity.
Right. We do have an email here. We have an email from Bradley. He asks, what's the difference between being a bond holder and being a shareholder? Do you want to take, you can both have that one because I think it's only fair.
So a quick comment is that as a shareholder, you're basically providing the riskiest form of capital to the issuer of the finance, to the company. So you've got the first loss piece. Basically, again, when things go wrong, you'll be the capital provider that suffers first. There is an in-between capital class, which is this hybrid stream we've been talking about, and then you have secured and unsecured debt or bonds, and these are just loans. They're no different to a loan you take out from the bank to buy a home, and think of yourself as being in the bank's position where you have an unsecured or unsecured loan against an asset, and you're paid a fixed or floating rate of interest.
Well, just to add to Chris's point, he's probably looking for more a risk perspective. From a return perspective, owning a share in the company, you're basically just owning a claim on that company's profits. If you own a company's bonds, you're entitled to a fixed interest payment from that company. So that's why, and interest payments are payable before the return. The profits are shared, so that's why bonds rank a bit higher up the capital structure. But if you're bullish about a company's prospects, you're better off holding the shares in that company than the bonds.
I like to think of it as you're either the banker to the company, and that's the form of the bondholder. You're either the banker or you're the owner. You just make a decision around that cycle where you'd like to be. Do I want to be an owner of this business, or do I just want to be like a banker? And often when we think of the bankers, we think they make an awful lot of money. So it makes a lot of sense in the fixed income piece to say, I'd rather be a banker at this point in time. But fixed income isn't everything, though a lot of us like it. We've had, and you're on the record, we've had Ken Henry, we've had Murray, we've had even Prime Minister Keating say we need more fixed income, and you've said that's not quite right. So let's talk that through. How make the case. I mean, I think fixed income is something, clearly we're at FIIG, so we're very keen on it, but make the case of why did you respond that way, and what were you trying to get? Because clearly a soundbite means they can sell a paper. I'm not sure you're actually saying no one buys fixed income.
Yeah, absolutely. And I will say as an aside, where were these guys in 2006 when we really needed them?
Fighting elections.
Yeah, look, I think what's missing from the discussion is, firstly, it is about valuation. Now, Chris mentioned the excellent return bondholders have got over the last 3 decades, but with government bonds, when your starting point is around 3%, it's mathematically impossible to get those returns over the next 2 decades. So I believe that over the long term, equities will outperform bonds, assuming that you're getting in at fair value or better than fair value. If you're getting in and you're paying too much for equities, bonds will outperform. I believe at the moment, equities do not look expensive, and that's why I think over the long term, I'm very confident they'll outperform. But just second, another very important point. People talk about equities as it's some homogenous asset class, right? But we know that's not true. At one end of the spectrum, you've got a small cap speculative mining stock, not generating any income, etc. On the other end, you've got a company like Telstra, and these are both called equities, but they're completely different. Now, would I subscribe to having a whole bunch of small cap mining stocks in your superannuation portfolio? Absolutely not. Do I think that you're well served with having high dividend paying blue chip stocks in your portfolio? Absolutely.
Or do you see, is it a combination of both that fixed income and that blue chip? To the point I suppose I'm trying to make, it's very confusing now. We've just spoken about how complex just even the cash rate. Where will it be next year? And it's harder. 5 years ago, 6 years ago, they predicted the cash rate. They stuck to it and they stayed with it. Even working out cash is tough. So trying to allocate money to equities, other than I want to buy the 4 majors and I want to buy Telstra. Well, I could make the case that with Basel III, the credit crisis being the way you can't, the banks will find it very hard to maintain their dividend, that it's very hard to pick equities to work out what it is. Now, we could talk about the banks and say, well, all they'll do is sack staff and therefore keep that dividend up. But it still is a very complex environment to be picking stocks right now. So how do you go about it? How do you construct that portfolio? Let's say I'm 25, which I wish I was. Let's say you're 25 and you want to construct that portfolio. Are we thinking 80% equities, 20% cash, or how do you start with a 25-year-old getting into the markets now? I'll start with you, George.
Look, I'd be more than happy with 80%, 20%, as long as they're the right sort of equities. And I will say with the bonds, I wouldn't touch government bonds. I think they're way too expensive, and I think they're being influenced by what I call irrational agents in the global marketplace, being the central banks. They're just keeping rates artificially low. So when I have expressing my opinion on bonds, I'm not really talking about bank-backed bonds, for example. We've had subordinated debt issued by the banks. I think they're a terrific deal. ANZ at around 6%, that's fine. Equities, I'm still cautious. So I would, 20 or so blue chip Australian companies that are paying dividends, 80%'s at the higher end of the range.
Yeah, right.
You know, 70, maybe 70-30. Yeah.
Okay, so back to that traditional balanced portfolio,
Yeah.
but we've got to be quite nimble. I mean, I'm 25. What will I do, Chris?
I broadly agree with John's comments that when you're at the start of your savings life cycle, you want to be exposed to these growth asset classes like equities and property. But I think the criticism of equities as an asset class is, as I said earlier, a strategic asset allocation question. And what we mean by that is when we look at Australia's super funds, the average weight to listed equities, both Aussie equities and global shares, is around about 50%. Before the crisis, it was up to 60 or 70%. And then if you throw in commercial property equity, hedge fund equity, private equity and infrastructure equity, about 80% of the fund has exposure to equities risk. Now that's fine if you're 25, but with an ageing population, they do need much more certainty of income. They can get it through cash and other bonds, as John's mentioned, these bank bonds that are yielding 6% that have no interest rate risk. And I agree with John. I think the government bond market is a risky place to be, but that's not just fixed income. Fixed income is a very broad universe, including cash, and cash is a terrific inflation hedge, and it's also a good deflation hedge. If the world craps itself out and the RBA floors the cash rate to 0 or 1%, all asset classes are going to get slaughtered. But in cash, you protect the nominal value of the dollar value of your investment, and you'll probably earn a real return of 3 to 4%. As you get older, that asset allocation will shift. So you'll have more bonds, more cash, less equities. But at 25, I've got no problem.
So we're closer to 40, which is getting a little bit closer to my age bracket. But at 40, we start to move in 50-50. Is that what we're starting to look at? Because we think we want to retire at 60, so we need to get some consistency around that return. Or how do you play it? Do you still say...
40's the new 25.
Right.
All right.
Okay, I'll work on that. I think, one of the things that we've picked up at FIIG, other than, and we can talk about this after the break, about the retirement piece where you didn't have enough and what do you do and how do you invest to that end. One of the things that's been very clear is that people look to invest now, particularly in fixed income, for a lifestyle choice. So I need money for coffee, golf, travel. I need consistency of earnings. So whether it be I'm a 70-year-old man or woman, I need to get a consistency of earning. Are you seeing that in the switching of your assets and your response to your investors? Are you seeing them look at maybe taking a capital hit later on because they're asset rich, cash poor, and looking to take a better return on the cash piece?
Absolutely. I mean, I think the fact of the matter is folks in equities, they saw the value of their portfolios fall by 40% in 87. In 2001, global shares fell by about 50%. In 2008, they fell by 50% again. So I think there's a lot of brain damage, and people are sick and tired of the 20% per annum volatility, so the huge fluctuations in that mark-to-market risk. And we've seen a big shift to cash, and I think a big shift to cash and bond-like alternatives.
Right, well, we must go for a break. We will take a short break. Please give us a call on 1300 30 35, or you can email us on yourmoney@skybusiness.com.au. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and tonight we have in the hot seat Christopher Joy from Yellow Brick Road Funds Management, and we have John Pearce, who's the CIO for Uni Super. They're here to answer your questions, and if you have anything you want to ask us about fixed income or the markets, please phone in on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Gentlemen, prior to the break we were talking about the ageing population, we were talking about portfolios, and I'm rapidly ageing. So the ageing population is a concern from the perspective of the fund manager at the moment, isn't it? Because the idea that you haven't got enough to retire on. Do you see that as a sleeping issue with both industry funds, with normal funds, with self-managed super funds? It's the growth sector, the self-managed super funds. So, John, what do you think about the idea that people are underrepresented in terms of the amount of money they've got?
Well, that's a fact, isn't it? That's just a fact. What concerns me is that there's no real product solution. In essence, the problem is people are retiring with not enough money and they're living very long, longer than expectations. So either you build a bigger pot, or you work longer, or you die earlier. Now, no one wants the third option. So either you... and the mathematics, you can't get a product to actually solve that problem. You can actually spread the risk, but then someone has to bear it, and someone wins. Clearly, government policy, I think, has to encourage more annuitisation in the process, so that people are not, basically spending their lump sums as soon as they get it. There hasn't been a lot of evidence of that, by the way, in Australia. People are generally being fairly astute, but lifting the superannuation guarantee to 12% is a step in the right direction, but there's no simple answers to this. At the end of the day, I can see a situation where, in my lifetime, people are having to sell their houses and trade down, and use the equity in their houses to sustain their lifestyle. I'm sure Chris has done a lot more work on this,
which they weren't expecting. Now we have a caller here from Jeff from Melbourne. Hello, Jeff. How are you?
I'm good, thank you. I'm good.
You'd like to chat about some hybrids?
Well, yeah, I'm always hearing and reading about people knocking hybrids, but and you're just talking about people being retired now. Commonwealth Bank Pearls 5, Commonwealth Bank Pearls 6, ANZ PA. These are all hybrids, and if, to my way of thinking, if you can buy them at face value and get over 3% above the 90-day bank bill rate, they become a very safe investment. I think you guys are putting a line through some hybrids saying that, what happens if this company goes under and all that. But I mean, geez, Commonwealth Bank, ANZ Bank, I think some of the hybrids are well worth the investment. What are your thoughts?
Jeff, I'll pass over to Chris, but in truth, you can talk about individual hybrids all the time. There'll be some good assets, and the ones that you've named may be good assets. We were talking about the new issuance. That was the question we were asked, and how people are taking advantage of issuing into the demand because it made sense to the issuer, not necessarily the investor. But Chris, your thoughts on Pearls? And
yeah, Jeff, I think it's an interesting question. I actually did an analysis of the CBA Pearls versus CBA's equity over the last 10 years, and what you see is the Pearls exposed you to the risk of capital loss during the GFC. I think they were down 10-15%. That's a big fall in value, and it takes a long time to recover that sort of loss. And so the concern, Jeff, is these hybrids are being sold with debt-like security, but they don't provide it. You would, in my personal opinion, be better off investing in the bonds issued by the banks, so AMP, NAB, ANZ, that John just referred to, which are giving you, were giving you 275 to 300 basis points over the cash rate. And they're genuine bonds. They don't convert into equity. The last time an Australian bank defaulted on a liability was in 1931, so they're exceptionally safe. And they give you almost all the return that you'll get associated with a hybrid, rather than, or without the equity risk. The other point I'd make is that obviously these decisions are complicated. There's a lot of analysis that is required. So the other solution is obviously looking at professional investors, be it super funds or managed funds, that can undertake that work for you.
Just to clarify, Jeff, we never mentioned that Commonwealth Bank was ever going to default or anything like that. The reason why we prefer the equity of the Commonwealth Bank because we think it's a very safe institution and a very profitable institution. If you hold those hybrids to maturity, you'll be paid in full. There is no question about that.
Now we have another Jeff on the line. Jeff, what's your question?
Jeff. Hi panel, how are you?
I think the panel's well.
I'm 70 years of age. I'm worth $5 million, and I've got $1.5 million in shares. And what the panel may be missing here is guys like me that the question is the return on your money versus how long you live. Now, if you've got that sort of money, well, where does the question come on versus the return on money? Who cares?
Jeff, I think we actually mentioned that. We were talking about the fact that you'd like a good lifestyle with the money you've got as opposed to what the end result is. You might be, it sounds like you're very cash rich anyway, but you might be asset rich, cash poor is what we were talking about. But can somebody answer Jeff's question? Who cares?
Well, if you've got $5 million, Jeff, I wouldn't be carrying too much.
Yeah, I'd be pretty relaxed. Yeah. I'd be happy. Would you be happy?
Yeah, I'd be delighted.
Jeff, and we're not trying to be trite. I mean, it's a reasonable question to ask in the respect of how intense can you be about your equities, and at 70 you've had a good successful career, so you've got money to spend, so we suggest that it's a good thing to go and enjoy it.
Can I just make the point that Jeff actually has in that portfolio a relatively low equities weight.
Yeah.
Now he's 70 years of age, he may be a very, very healthy man with a long life expectancy, so he may, from a strictly theoretical perspective, be doing exactly the right thing, and it is about trading off your risk versus your return. There are some 60 and 70-year-olds that want to swing for the bleachers and they want to get very high double-digit returns, and you will only get that in risk asset classes. There are a lot of other folks that frankly don't give a rat's ass about the double-digit returns, and they just want their monthly or quarterly paycheck, and they want to know that no matter what happens, they don't see the value of their portfolio shrink by 1/3, and that's why cash and fixed income have a role to play.
Yeah, great point. So the thing that I would wonder, active versus passive. The growth in the investment sector that's growing the most is self-managed super funds. So I'm not 100% certain how they're going to be treated. But an active manager versus a passive manager, what do you think, John? How do you think the market will shape itself out in terms of everyone being active, lots of alpha, lots of trading, or do you think they'll go back to historically very passive, put their money with somebody?
Look, the market has got a lot more inertia than people suspect. You know, I suspect that turnover has increased, but it would be probably 5% of our member base, and I think we're a reasonable barometer of the general market because we're a big fund. We've got about 350,000 members. You know, one thing I will say, members don't have a great track record when it comes to timing markets, and the three biggest drawdowns we had, or moves from growth assets to cash assets, was the 3 months after the GFC,
right.
And it was just at the wrong time to do it. So I think there's a lot to be said about a well-diversified portfolio and holding on for the medium term.
It is that volatility question, isn't it? It's that question of, do I, it's not even if I need the money, I'm just nervous about the fact that I wake up at 3 o'clock in the morning and look for the Dow. That's the error. I'm in the wrong portfolio. Or I turn to my partner and my partner says, I thought you said this, you were good at this. I thought this was supposed to be easy. I thought we were supposed to live off your wisdom, and all of a sudden you can't defend the positions that you've got. So that volatility is the key to a lot of the investments, isn't it?
Yeah. I think on active versus passive, there are two dimensions. One is the growth of self-managed super. So about $450 billion of the $1.3 trillion of all of our super savings is now self-managed super, which means that mums and dads are managing their own financial destiny. And that's an extraordinary development. And that's all about education, information and empowerment. I don't think that's going to stop. I think that's going to continue. The second question on active versus passive is, do I want to go with a large institutional fund manager that's going to give me an index return, or what's that?
I'm sorry, we're going to have to wrap it up. Thank you. Thanks for your commentary, guys. It's been great. Thank you all for your time tonight. It's been great with the calls and the emails, and we really appreciate it. Have a good night. Your money, your call next week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate